So what have been the critical success factors on microfinance 30-year path? Vulnerabilities and missteps, what lessons are more broadly relevant? What can impact investors learn from microfinance? And how should microfinance and MFIs be positioned for the next 10 years? So a huge program, and I'm very happy that we're now 5 on the panel. I think we started the first panel by talking about, is microfinance alive or dead? And it was pretty clear it was dead for donors, but it was well alive for many others and for the practitioners today. Maybe not for the early investors, but for commercial investors and large institutional ones. We then spent a lot of time, probably in the second and third panel, talking about the role, the new role of that MFI, or the changing role of the MFI. And I think that's a fundamental discussion we can a bit come back on, since we were supposed to project ourselves on what are the MFIs going to look like. And most strikingly, how will the digital revolution impact microfinance? Maybe in 20 years we'll be here talking about digital revolution or footnote.
It will only be our avatars.
And then we touched upon our definitions about, and I do think it's very important about who's the client. We do have 2 clients, but we always forget to have the investor discussion, I think. And so that's about it. I had put on my notes, and so just as little topics, and I'll let each then start. 3 points. I think the main success is scale, and I think we all agree on that. It's amazing. I think, Damien, you started with that, and it's just amazing how it's gone beyond our, the dreams of anyone who started early in the industry. And so the things that we're less comfortable sometimes about discussing is, again, the fact that there's no M&A, there's very little equity, and so what's happening with the shareholders today? Are they not entrepreneurial enough? Or is it logical to have more patient institutional investors at this stage? If we want our MFIs to go to the next step and onboard digital, what does it mean in terms of type of investors? So 1 is equity, 2 is the role of subsidies. I'm sure some of us will have strong views on that or have done some research. Was it necessary or not? How big was it? And are subsidies needed to continue or not?
Yes.
Okay, so we have a start, and I'll just finish, and then I'll pass you the. The third one was it was regulation. I think we didn't talk a lot about regulation, but we know how fundamental it was, both for the MFI and for the investor and for the end client or consumer as well. And so maybe we can touch upon that, and I'm sure both Damien and Sanjay will have some things to say about the regulation. But did you want to start on subsidies, or?
So there's always was a lot of subsidy. There continues to be a lot of subsidy, and there's a lot more subsidy. Subsidy will continue to be needed because we know exactly what happened or what it will look like if there is not subsidy. It will look like the United States, which is light touch regulation that allows for a lot of gray market and substantially bad for the poor financial products to exist, because that's the way you make money when you don't have subsidized profits or subsidized operations. That being said, I think the way that microcredit should be positioned in the impact investing community is one of the highest possible return impact investments now, because what we see, looking at where the state of the industry is that it costs about $26, on average across the world, it costs $26 per borrower per year. And so if you stop framing microcredit as this escape from poverty and the literally cheapest job creation and management training program that the world has ever seen, then essentially you've got a zero-cost platform to invest in for additional innovation that can, we know it's not as long as there's good regulation, of course, and you've got pro-poor institutions, it's not going to hurt very many people very substantially. So if you just make it even slightly better, you've got hundreds of millions of people you can reach at very, very low cost, and I don't know of any other impact investment out there that has the possibility to reach that many people that quickly without needing to like fundamentally transform their lives. If you've got something that's already doing good and is essentially free, a slight uptick in impact at this sort of scale is huge. And I don't know that there's any other impact investment out there that can make that claim.
What do you refer to when you say we're creating all of these jobs for free? Whose jobs are you having in mind?
The people working for MFIs.
Well, I'm not so concerned about the people working for MFI, but interestingly enough, I always had kind of a feeling that subsidies for MFIs were achieving just that. Mm-hmm. You're subsidizing middle class people, which people working for MFI are in the context of the countries where they are. But that's an interesting, totally new angle that we are creating employment by employing people in the MFIs.
Yeah, and I mean, just further to that, and I think, Paul, there's this paper is out there, and somebody else told me I had to tell everybody that if you don't subscribe to the 5, then you should. It wasn't me that said that, it was them. But further to that, like we've created these incredibly, at least on a relatively basis, well-run institutions in lots of contexts where there are no other well-run institutions. We've created businesses that treat poor people with respect and dignity where there are no other institutions that do that. And so I think there's, if we abandon we're going to put poverty in a museum, and then just look at, are you doing good at relatively low cost, then you've got this huge platform for upside.
I would like to link that. I think it was the second panel where René, are you still here? Oh, I'm sorry. That's a pity because René sort of painted this marvelous panorama of a great future in fintech and what's the other one? Yeah, one day I'll learn the difference. But let me just use the word fintech for all of that. I think what that ignores and what some of the discussion since then has ignored in other panels is, I mean, we always have to ask ourselves, what are we really doing? What good are we providing to the client? And the good that microfinance, in my world, my way of using the word, provides to the client is that by giving a relatively small amount of money to the client, you unleash creative potential. You enable that client to create value. And that's really what it's about. It's creating value. I'm afraid it's monetary value. It comes down to that. This is what economic development is. And if you do not create value, then forget it. Why should clients bother with you? Okay, I mean, if there was one, Alison, I think you kind of referred to it when you were up here the first time, where you said, well, it's kind of in passing. It's pretty clear, so studies show that the social impact is maybe a little bit, but maybe a little bit under or over. It's probably neutral. There are only two possibilities. Either this is true, or since it is entirely implausible, it is not true, and you have a measuring problem. And why is it totally implausible? How could you get the growth that we have seen in microcredit unless it really does something for the client that's valued by the client? And I've always had that kind of suspicion in measuring social impact, social performance, that we have a measuring problem. That way we measure it and the things we measure may not be the same things that the client actually values. But back to where does that connect to fintech? If all we do is develop ever better ways of predicting who will pay back, that ignores totally what's being done with that money. and that is not the way forward, I suspect. I don't deny that technology will enable us to become better in our analysis. But so far, at least in Latin America, and I'd be interested, Sanjay, to hear your perspective from other parts of the world, but in Latin America, I don't see the impact of fintech. In fact, I don't see much use of it, except in management information systems. Okay, that's clear. Let's leave that aside. But in loan processing, to me, I kind of ask myself, is this hype or why I'm not seeing it?
I could maybe respond to a couple of those points. So on the question of measurement, so yes, JPAL is a network of researchers that conducts randomized evaluations of different social policies and programs, and over the last maybe decade has conducted about 200 such evaluations that are focused on financial products and services, many of which are credit. And I think what I was referring to in passing was the series of impact evaluations that were looking at the impact of access to kind of the traditional credit product that addresses the information asymmetry issues that Shannon mentioned earlier, and that did expand rapidly around the world, which obviously does show that it was meeting some sort of a consumer demand. Otherwise, people would not have taken it up. But what these studies were measuring was basically the theory of change that was laid out by the industry, that with access to finance comes increases in business activity, with increases in activity comes business growth, and from that business growth comes various social improvements and improvements at the household well-being level. And at least in those set of studies that we think are pretty representative of what the industry looked like, probably in like the mid-aughts, you see not massive demand, actually, so suggesting that traditional product maybe isn't actually meeting all of the needs of potential borrowers. Some limited increase in business activity, and then very few sort of translations into improvements in well-being at the household level. So this is the traditional product. This is in most cases group liability. It's repayment immediately. It's repayment every week. And we know that the industry has moved beyond that in a lot of ways and has really innovated in the kind of product design space. And there is evidence that many of those innovations, more flexible repayment terms, less frequent repayment, more individual liability, more creative approaches to collateral, do actually lead to greater impacts both at the business level and in some cases at the household level. So I wouldn't write off, credit entirely, but I think it is fair to be a bit, to question our own assumptions about how well it does work and to try to look at this evidence. It certainly can't pick up everything. It's important to complement, qualitative or quantitative evaluations with qualitative stuff, with stories from borrowers and things. But I do think it challenges us to think about whether MFIs actually should push beyond credit. And I know that the business models are much more complicated, but the evidence, at least that has been generated by researchers in our network so far, finds that there's a lot more evidence of positive welfare gains from other products and services. So there's a lot more evidence of welfare improvements from access to savings products. Obviously, there's a lot of regulation issues there around whether MFIs can be deposit taking or not, but in cases where they can, there's a lot of evidence that there can be improvements at the household level there. The evidence around insurance is kind of mixed. Obviously, this could be an extraordinary product, but so far it's not really commercially viable. There's a lot of evidence around remittances being better for welfare enhancing or welfare improvements at the household level. So I think it would be useful to think about how MFIs going forward can actually figure out how to, the credit model is pretty well figured out, but how can you move beyond that into more diverse products and services if the end goal actually is these welfare improvements? And maybe that's not what the impact investors are looking for, but if that is what the MFIs are committed to, then I think figuring out how to move into that space would be really, really important. And I think the other thing that I would caution in going forward is, obviously there's a lot of enthusiasm around credit and the evidence is a bit more mixed, that we should be similarly skeptical going forward in terms of our enthusiasm around digital finance in particular, that there's potential downsides as much as there are potential upsides. So proceed with caution and test. And I know we test things at JPAL, so we like to say that, but we really do think it's important to test this stuff as we're rolling it out before it expands massively, and to make a decision around whether it is actually a place that warrants subsidies. Because in my view, the subsidies should be in a place where it's creating enough social value, or where it's just innovating on the model and it's testing and it's not something that's going to be commercially viable. So use the subsidies for the testing purpose.
Thanks. And of course, Sanjay, maybe you can comment on that. And if I think there's a lot of data and benchmarks showing that most MFIs are diversifying actually and adding liability products, not only asset products, and are also adding non-financial products. And can you project yourself in 10 years and tell us what you see? And also in terms of subsidies, I mean, do you actually believe that the industry is that subsidized, and if so, will it continue?
So let me come to the point about microfinance. Alison just said that she felt that the microfinance model had been figured out, and I think that's broadly true. But from my perspective, from where I look at microfinance in Asia, I have a very serious concern, and I think it reflected in some of the things that I said in the previous session, that while MFIs perhaps know what needs to be done, they're not doing it. The reason they're not doing it is that profit has become the ultimate criterion. Returns on assets are now reaching 6 to 8%, which translates to returns on equity of 25 to 30%. It's not clear to me that an impact initiative needs returns of that order of magnitude. I'm talking about other parts of Asia too. I mean, Cambodia is a serious example. Some of the MFIs in the Philippines are in that position. I know that the financial institutions in Indonesia that are related to microfinance have very high rates of return. All of those. Essentially, where we've reached with microfinance is that while there has been some innovation, there hasn't been enough innovation because a successful businessman, I mean, why would you fix something that's working well for you? And these guys, the MFI leaders, have become businessmen. So you know they're fine with what they're doing, but what are they doing? In India, in Nepal, in Pakistan, in Myanmar, they're giving $300 loans to people who need $1,000. When you're giving $300 loans to people who need $1,000, what are you doing? You're forcing them to go to other MFIs. When they borrowed from 3 MFIs, they still only got $900, so they go to the 4th, and at that point, they're overextended. They didn't really need $1,200. And what's more, each one of those 4 MFIs, the underwriting they've done, the assessment they've done is on the woman's capacity to pay $300, not to pay $1,000. The whole business model is just completely wrong. As a result, there is significant overheating in many parts of Asia. I can name states of India, provinces of Cambodia, Myanmar, elsewhere. There is significant overheating, substantial, multiple lending, which is leading to some degree of over-indebtedness, but also it's leading to microfinance being used for often as consumer credit rather than production credit, which is what it was supposed to be about. We all, I'm equally guilty at the start of having done this. We sold microfinance to the world as production credit. My guess at this point in time is that about 35% of microfinance is production credit, and all the rest is facilitating people's lives, also a useful thing to do, but at other points in time, perhaps not facilitating people's lives. And there is evidence emerging from research studies in Myanmar, in Nepal, some in India, that it's actually, in a few cases, 3 to 5% perhaps, leading to immiserization, which means you get people reporting cutting down on family meals because they didn't have the money to repay the next installment. We need to be aware of these cases. It's happening. It's not happening in a huge number of cases, but it only took 50 to 70 suicides in India, not all of which were attributable to microfinance. In the end, when you really look at those, there were maybe 10 or 12 suicides that were attributable to microfinance in a state with 6 million microfinance clients. And yet it led to a huge crisis which caused the reputation of microfinance all over the world to be affected. So the point of talking about all this here is that I think investors themselves have a certain responsibility, which is not just in earning a return on the investment that you put into microfinance, but also looking at the business models of your investees to see whether they can do what they're doing a lot better. And because of that, I also don't think that digital finance, the way some of us imagine it, is the answer. I think Claudio painted a good picture this morning when he talked about understanding the household, understanding the economics of households, understanding the livelihoods needs of households, and addressing those needs. There's a lot to be done in that field, and it's something where all of us as my company, similar organizations in Asia, as researchers, to push for a shake-up in these business models, but also for investors to do it. And that's sort of what I was saying earlier, that you've as impact investors, not as pure financial investors, as impact investors, you've got to look at the impact that your investment is making. You can't just say that it's microfinance and therefore it's impact investment. You've got to do a little more than that. Some impact investors do social impact studies of their investments. I think that's good, but not enough do. Most simply rely on the fact that it's microfinance investment, and that's what they're selling to their investors. And I think that's where there's a problem today. At least as far as Asia is concerned, I have to say that I think very substantial amount of domestic funds are now flowing, that there is a natural commercial impetus in microfinance. And I'm not saying abandon it altogether, but what I am saying is also start to find new areas of impact investing, create new funds, health-focused funds, value chain and agriculture-focused funds, and so on. These may be $50 million, whereas you've got $1 billion in normal impact investing. But start somewhere, because that was where microfinance impact investing started 15 years ago. There were $50 million and $100 million funds, at best. So that's what needs to be done. I believe that microfinance has become a proven model. It needs to be tweaked and improved to serve the lives of low-income families. But it's also reached the stage where the banking sector has become increasingly interested, and we can allow microfinance to be provided by banks as well, by large banks as well as by graduated small banks.
But those are inconsistent, Sajay, right? Because if we let the banks do it, we know exactly what they're going to do. They're not going to do the things that tweaked, right? They're just going to farm that for profits. If you do want to see the microfinance institutions innovate in ways that are measurably socially good for the customers, that's not, the banks aren't going to provide that financing. You've got to have impact investors who are, and my case for this is not that investors into microfinance generally, that's impact, but impact investors who are structuring their investments to drive innovation are absolutely necessary to improve the impact. And if there's not that, then there isn't going to be any impact.
The graduation of MFIs into small banks, and it's not just happening in India, but also in Cambodia, and it's happened in Indonesia in the past. The graduation of MFIs into small banks, I think, is a very positive move because it makes deposit products available much more easily to the kind of people that we're trying to serve. It also makes commercial capital locally available for this type of activity. I think I think it's reached a certain stage where, with some support, with some encouragement from those who are concerned about impact, where these new institutions that are recognized by the regulators as banks, that they would significantly continue to serve the areas of the market that we're concerned about. That doesn't mean that MFIs, as we know them today, will die out completely. They will always have a role in some areas and more difficult to reach areas, and in certain niche segments of the market. But what I'm saying is that broadly, the international impact investing movement needs to start to reduce its focus on microfinance and to increase it on other areas of the lives of low-income families.
I would, if I could just add a Western Hemisphere kind of correction to the picture you're painting. In the Western Hemisphere, I don't see these very high rates of return. Rates of return of more than 2% would be really high. 1.5% is more common. On assets, and on equity. Well, it depends how much your leverage is, but yeah, you're probably up there in the teens. But also the days of the really high returns in the 20s are over. You still find a few in some niche markets who are hitting it rich for a time, but competition really sees to that. Also, there's a bit of sort of a tone, a nearly Yunus-esque tone, Sanjay, I would say, Mohammed Yunus-like tone, of saying, well, look, these guys go in there, these entrepreneurs go into microfinance because that's where you can make a quick buck. Again, I think that happens, that's a sign of imperfect markets, where the markets still need to grow up. I can't think of a market right now that we're familiar with where that would be the case. It used to be the case in Nigeria. As somebody said, that's the Wild West of micro credit. Wow, and is it ever? I mean, anything that you can imagine you will find in Nigeria. But even there, competition is starting to bite and to bring down rates quite fast. And today, to be successful in microfinance is not a cushy job. You have to really be on the run and run hard, because if you're not, you'll feel the consequences. Why am I calling this Yunus-esque? Because Mohammed Yunus has this kind of zero-sum theory that profits made by the owners of microfinance institutions is money taken out of the pocket of the poor, of their clients. Whatever, the more profitable they are, the worse they treat their clients, and the more they steal from them. And that's, of course, that's a basic fallacy. Enterprises will not survive if their business is to, I was going to use a indecent word, to not treat well their clients. Because you will simply not survive. It has to be a win-win for both sides.
You know, I'm struck by this divide that has trailed through the whole, has followed us through the whole day about microfinance and as a maturing product, but still with growth. Actually, I think it's going to be very interesting to see where India goes, because India by itself, if these new banks work, could add a significant piece to what microfinance is as a whole, just given the numbers. But also the policy's gotten right. So if you get the policy right, unlike the U.S., I've heard Tim talk about the U.S., we did a strategy for the U.S. Treasury on, and we did a study on the U.S. microfinance market. It's a debacle, and it's all subsidized because they've gotten the policy all wrong. So if you get the policy right, microfinance can continue to grow, and it can contribute. So then what do you do about impact investing? I think the way we've been discussing the model on impact investing forgets the history of microfinance. Microfinance largely started with relatively small institutions all over the world. I had a chance to look at a lot of them because they were all putting applications in for grants to CGAP. And, you know, 2,000, 3,000 clients, they've been operating 3-4 years, and they were looking to build capacity. And they were, so we began to set standards on financial reporting, on measuring operating performance. We began, not only was CGAP giving money at the time, we had about $50 million in funds over 5 years, but the donor community was adopting standards around standards that we were proposing. And so there was about $300 to $500 million. We couldn't measure it properly because it was a rounding error in what donors were giving. They didn't even have a definition called microfinance. So we began to get reports on all the projects, and some of it was really crap, so we filtered it out. And we got an estimate range of $300 to $500 million before any funds, except Alex's fund, ProFund, was created. But Alex's fund was, Latin America was, what, $22 million, Alex? So it was a good pilot, but the real money didn't start coming in until 2000, 2005, and when you began to do your reporting on the vehicles, different investment vehicles, and now Symbiotics does their reporting on these vehicles. So the problem with impact investing, either we see, this is my proposition I'm throwing out, either we see the microfinance institutions diversify and scale up, but that really will take some support. Maybe soft support, but more perhaps better training, better governance, better this, and some emphasis from their funders on seeing them diversify their product mix. I have seen it in two significant cases where it's just damn difficult, and I imagine everywhere it's damn difficult because they only do working capital loans, and that's easy to do relative to any of the other impact investing areas. Or you start funding institutions that will do other things, education, healthcare. You can't start with the funds. The funds need institutions to invest into. Therefore, you probably are going to need soft money. No one likes to hear about it. You're going to need donor money or a mix of donor money and other money to create institutions that are viable, that will then attract investment funds to put money into viable institutions. I don't see how it can begin with the funds putting their money into impact. We'll get some of it, but you're really not going to scale without real institutions on the ground. Those are my thoughts. I'm curious what you're thinking.
And well, maybe Timothy, you can, since you quoted twice the number $26 per client, you can tell us a bit where it comes from in terms of is it pure grants, or is it actually supposedly below market rates? But then, how do you define market rates, or where does the number come from?
So I'd refer people to actually to the paper itself, because obviously calculating that, you know, you're going to need the technical details, and if I say it to you, you're still going to need to see it to see how that's calculated. The paper is called The Microfinance Business Model. Cull et al. I'm sure most of you know Bob Cull at the World Bank, that details that. It is the majority of the subsidy is from below market rate funding.
Does it define that, or?
Yes, I mean, the paper goes through in detail how they calculate it for each country and what the actual market rate. And basically, the concept from economic analysis is, where would this money be coming from if there weren't people who are making a deliberate decision to invest in microfinance? If they truly had to compete on global capital markets or local capital markets without any sort of people making a specific decision in this direction, what would the rates of capital be that they'd have to pay to continue their operations? Now, you know, those subsidies are all over the map, because different organizations have different levels of investability, have different levels of efficiency. Organizations in Latin America, where there's not as nearly as much population density, it can cost a lot more to deliver than it does in some of the densely populated countries in Asia. And so, the usefulness of the $26 figure is to say, you know, that's not actually very much money when you look at it in comparison to other possible interventions that are out there.
And the subsidy element is largely gone compared to what it was.
It's much lower than it was, but I mean, I don't know whether you consider on average $26 per borrower per year across the $150 million, just to not be significant. I mean, that's actually a lot of money.
Let me maybe go back through the back door. And you mentioned a while ago that, you know, if the MFIs were to somewhat fade, then the commercial banks would take over. And in a way, you implied commercial banks, meaning existing traditional universal banks. In a way, you implied that they would, using Damien's words, screw the clients. But, you know, in a way, if we were to do that, then there would be no subsidies. One could assume that, you know, traditional banks are not getting any subsidies. They're taking, and again, like Damien, talking a little bit more from the Western Hemisphere perspective, and I know and I can see how this might be different in other parts. Mind you that what I've seen in Africa, it's not so widely different, but then again, Asia might be. You know, if you look at three kinds of players, you see NGOs, you see NGOs that have transformed and are now banks or non-bank financial intermediaries, regulated financial intermediaries, and then you have the universal traditional banks that are entering the market. If you see the same client that maybe has loans with each one of those, and that is sometimes the case, there's really no big difference in the kind of product that each one of those players is offering. What I'm trying to imply is that, you know, be it a microfinance institution, an NGO that's transforming a bank, or a traditional bank, or for that matter, an NGO that offers the product to this particular client, there's not going to be much difference. The reason that raison d'etre, if I see was mentioned earlier, for a lot of the microcredit to exist to begin with, because there was a market failure, because the banks were not interested. Oh my God, suddenly they are interested. We should applaud that. You know, the subsidies are gone. They're offering the same product. Mind you, there's going to be a little bit less care, if you would. But, you know, some of those banks are actually doing the job quite well, again, in the Latin American context. You know, it should really be for the NGO, for the subsidies to go, and because, as we already said, there is a very small segment of the population actually that is being included. There's a big chunk out there that is not, and the banks are quite still not interested in that. So the smart money, the subsidy money, the NGOs should be going after that market. Well, that means a lot more work. That means, you know, being innovative. That means changing. That might mean including even trying different things like digital.
again, just trying to put things in a different perspective.
Yeah, I mean, I essentially agree with everything that you said. In other work, nonprofits do serve different customers than the for-profits do. Nonprofits serve more women. They serve poorer customers. That's unsurprising. And if subsidy pulls back, then what you're going to see is that across the board, whether they're nonprofit or for-profit, every organization, like this is the law of evolution, every organization that exists, its primary purpose is to continue to exist, right? So if they're going to continue to exist, they're going to have to make up that money. They're going to have to raise rates. They're going to have to serve customers that are cheaper to serve. They're going to have to find money to invest in operational efficiencies. But when your cost of capital is going up, it's awfully hard to find money to innovate and bring down your costs. So the first thing that you do is you fire your most expensive customers and you raise your rates. And I think that's what we'll see.
Your observations are quite different from mine, and I would suggest that we have this out, not here on the panel, but among the two of us, and return perhaps to where is microfinance going in the next 10 years of, was it 5 years?
I agree, yeah.
And I nominate Allison to take the lead on that.
And maybe, Alison, just one question as an intro.
Sure.
Do you do correlation analysis between the results of the MFIs that produce good social results and their financial indicators? Or you just focus on the actual social outputs?
So generally, these studies are looking at like kind of a range of different impacts. So looking at like the financial health and sustainability of the MFI itself, but then also looking at these. I mean, I think there was a question earlier around, is it even possible to measure these sorts of things? And it is, using an RCT or other methods to measure the impact on business outcomes, impact on household well-being. So looking at both, we don't have a number on like a correlation over all of these different studies on bank health and well-being and social kind of indicators, though.
Because I mean, for me, these are really two fundamental topics. There's a narrative that microfinance is subsidized. I challenge that, actually. I don't believe it. I think the loans that the MFIs are paying are actually locally are market rate of return, and they would pick the local ones. Well, they would stop borrowing, or let's say the foreign ones are decreasing, and it's the proof also. But the foreign ones are still LIBOR plus 3 or 4. So anyway, I think there's a narrative where we need probably to clarify, to go back a bit to your point of, definitely at the beginning there was some subsidy, but it's probably gone, and I think that's what you were trying to say. And then there's a narrative that we're not necessarily producing any positive social outcome. I know that's not exactly what you're saying, but that's the risk, and it's also in a sense dangerous. And so, working from these two elements, trying to project ourselves 10 years, what's our picture? Damien, you were starting something.
Let me just interject one more thing. When you mentioned cost of funds, actually, and in line with what Dominic is saying, as you go more into the commercial aspect and you are taking money locally, be it from raising bonds or just by taking deposit from the public, your cost of funds actually goes down, if anything else, because you don't have anymore the FX risk that taking money from abroad might imply. It's difficult for me again to think that there's, and again, talking from the Western Hemisphere perspective, that somehow there's an element of subsidy particularly in the cost of funding. The big players are not taking much money from international sources, and they're raising money domestically at very much market rates. That has actually produced a drop in the rates. Just to strengthen.
Yeah, I don't recognize the $26 subsidy figure. I don't know where it comes from. In Asia, the only countries where you see a subsidy are East Timor and Myanmar. That's it.
I'm sure it's very complicated. We all need to, read the technical note. But, for example, I don't think it's ridiculous to say that the a priority sector lending requirement in India is an implicit subsidy. And that's been a major, major source of financing for a huge industry.
Currently,
Similarly, I would
currently at 14% per annum.
whatever it is,
It's-
it's directed credit. Okay, whatever the rate is, it's being pushed to those
but,
institutions. So this is a technical. And I would also just say, as an equity investor, very very sadly, I would have to say that, not to be quoted to my investors, but I don't think that the equity investors are being adequately remunerated if you look at it strictly from a market standpoint for an emerging market private equity investment. So there too, I think there's some kind of subsidy.
And I would suggest before we sort of really dwell on it, I mean, that this is just a specific thing, that if you go and read that paper and the analysis is wrong, I want to know, right? So please, go read that paper, the microfinance business model, Bob call it all.
I'd say relative to what's being subsidized around the world by donors in a large way, I've followed this and I've read in Jonathan's books and I've read a lot of material, written some notes on the subsidy myself, and I think it's a minor issue now. It's really become a very minor issue in microfinance. It's not at the heart of the 10-year issue. But what is at the issue, and I want to ask Allison just a hypothetical question, is the return from microfinance, the social return, the value added. From being in the field and visiting clients, particularly with compartamos around Mexico, where my Spanish is good enough to talk to clients one-on-one, I always got the answer from people, how are you doing, how's your business doing, etc. One of the things they always answer is that at least their children are in school and being educated. And the reason I found that very profound, I compared that to the U.S. experience from immigrants, Irish, Italian, Jewish immigrants. My grandmother came from Russia, actually Ukraine, but she considered it Russia. It's Ukraine now. She considered it Russia. She came as a widow with 2 sons, and she married, and her husband died, and she had a daughter. She raised all of them by running a small business. She certainly did not get rich or see her income grow, but one son became a doctor, the other a lawyer, and the daughter married an engineer. Sort of a classic American tale. So if in fact the children are getting educated, and they are going to have a better life standard, they're getting fed better, have a better way of life, couldn't we reach a hypothesis is that this is a next generational issue, that in fact the people who are toiling and building these small businesses and supporting their family, we call them lifestyle businesses. In the U.S. we know this all the time. The greengrocer, it used to be all Italians, now it's all Koreans in New York. The newspaper vendor used to be all Jewish, now they're all Indian. In the people who own diners, they're all Greek. I mean, and these are the people working, 80-hour weeks, but they're making it for their kids because their kids are not coming into work in those businesses. They're all having, large majority are having a much better life than their parents ever had, and perhaps their grandparents who were the original immigrants. So what about a hypothesis, and I don't know how we test this, that in fact the next generation is going to do a lot better, and that's where the added value is going to be?
I think, I very much agree and hope so. I think that's presumably why we're all doing this. Yes, absolutely. We certainly hope so. The question, I guess, that I would ask is, with borrowers in compartamos, are their kids attending school at a rate that actually is different than the rate of school attendance among non-borrowers? So that's a first question that you could ask. Is in some way this credit enabling the family to change its circumstances in such a way that they're choosing to invest in their kids' human capital, in their education and their health in a way different than they would otherwise? I can only speak from the set of studies that exist so far, which are looking at impacts like 3 and 5 and maybe 7 years after borrowing, and we don't see so far with those like kind of traditional credit products a significant change there. But that's in part because we're not seeing huge take up of the product in the first place, and so all those other results are going to be a little bit diluted from that. So the beauty of an evaluation like this is that you have your treatment group and you have your comparison group, and they're going to be comparable for 50 years, for 100 years. So we could go back in a generation and actually see if there is something that, maybe it's a slower burn before this actually starts to show real measurable results in terms of, how well those kids are doing when they enter the labor market or something. So it's certainly possible we could test it. I think the sense is, though, not really seeing the theory of change bear out in the first 5 to 7 years, to me, makes me skeptical about the traditional model. I do think where we see some of these tweaks, like with repayment, like a grace period, for instance, study that was conducted in India looking at introducing a 2-month grace period saw like a 40% increase in business profits. And that's like on the magnitude that we're not seeing with the traditional product. But they're getting to, I think, your question, Roland, there was also tripling in the default rate in that case. So there's potential huge benefits from, those businesses, those clients, but from the business of the bank, it's not so much, profitable or feasible. So there's a lot more, I think, innovation in the product that still is necessary to figure out how do you get to the point where you can unlock those business returns while doing it in a smart way to ensure that the default rate doesn't go up so high that it's not a sustainable business. So I think there's still hope, but I do think that it needs a lot more innovation, and it should be tested the whole way to figure out which type of product is actually going to help to get those kids into school. And this is where I know I keep coming back to these other products. There's a lot more evidence that with access to savings, that can enable you to have access to the capital necessary to pay the school fees on time to make sure that the kids aren't sitting out.
Don't we consider savings just now a normal part of microfinance for the institution?
Yeah, is savings a normal part of?
Okay. I would integrate savings analysis with the credit, because now we've built sustainable institutions. You have savings.
Well, you have lots of savings accounts. You don't have very much savings.
Yeah.
But I think in Africa, savings have been much of the story. You look at all the, I've been involved in raising a lot of money for African microfinance, and I've been the chair of a technical assistance company to 10 microfinance. Now I'm on the board, Amiga, and I chair the finance company, and we see many more savings accounts than we do, and then we have savings. Equity Bank, which is an enormous success, is a savings juggernaut. They opened 50 branches, and they were a failed bank, and now they're a savings juggernaut. So I would say you really have to consider savings an integral product, and I would absolutely agree that savings, but that was predicted many years ago by some of the people writing on microfinance.
But we have to look at the history, right? We've known that savings is a path to upward mobility, as you said, forever. Look everywhere around the world. Do poor people save a lot of money? No. It's hard to save.
Yes, they
Oh,
are.
no, I'm not saying that they don't save. I'm not saying they don't save. In fact, I often make an argument they do save a lot more than we count, but they don't build up savings because they're poor, right? They've got to use the money for the things that are, that's what we see. We see that households that are poor do what's called high transaction savings, where they save some money for 3 weeks and then they need to spend it, and they save again and they need to spend it. They're not building up assets. That's why they're still poor. I think back to Ira, your point about how we think about, there is very much a theory of change thing that social investors need to take into account here. To your point, over the next generation, if you don't see that in 7 years that the children are in school more, that the nutrition levels are increasing, that food consumption is increasing, that incomes from the businesses are increasing, that all these sorts of things that you measure, then you have to wonder, how is that going to benefit them? On the other hand, right, the most promising poverty intervention in the United States in the last 20 years is this program called Moving to Opportunity, where they gave grants for households to move out of poor neighborhoods into good neighborhoods. It was an absolute failure for 20 years. No effect or negative effects, until the kids who were less than 10 when they moved got into the labor market. and suddenly it's a huge success. Well, the program doesn't exist anymore because it was a failure for 20 years, so they canceled it. But now that we can follow those people for 20 years, we see a similar thing with deworming, right? Deworming, we don't see measurable effect in the first 3 to 5 years. The kids don't gain weight, they don't have lower rates of anemia, they don't pass school at a higher rate, but 15 years down the line, they make much more money. So you do have to sort of, this is a faith-based decision in your theory of change about do you need to see impact in the first 3 to 5 years to believe there's a 20-year impact or not?
I would not expect, having run small business, and we've always had small businesses that my wife's owned in the family, to see any impact over the first 5 years or so. It just takes a lot of time and effort to build a small business, and the gains do not come to the entrepreneur that quickly. It's what you do over a more extended period of time. And are we tracking education? Are we tracking nutrition from the microfinance in our control? It'd be interesting to see what that says.
I just want to add one very small point from the side of the MF5. I have 25 years in a MF5 that transformed from an NGO to a bank, and it's very difficult to grow. It's very difficult to have scale. It's very difficult to build a team. It's in other scenario like this, the first thing that you listen is mission. We are missing here the mission. We are missing here building teams that respond to the win-win that you just said. The client need to win, and the institution, the bank or the NGO need to win too. And the innovation is there, and it's much faster the way that the client needs are moving, that the capacity that we as a bank or as an NGO or as an MFI are moving in any aspect, in interest rate, in kind of product. So it's very, very interesting for all of us to go very close from the work that every MFI and every client, and Alex just visit Adopen and have the opportunity to talk with one team of young people that are just taking loan to study. And for him, maybe he can express better than me the experience that we got together, listen, how they were sure that they won't receive that loan, and how is the impact in everything, in every aspect of their life, that they are now, the possibility to finish and to be a professional. And the motivation, the commitment of those are completely different. And as you said, the institution that give the client the $300 or 300 loan, and then they go to the other one, 300 more, that is not completely the real situation in any country. You have to, the risk is the good evaluation. Maybe sometimes they say, we don't have any bad client, maybe we have bad credit officer that don't know how to do a good evaluation, but you have to be very careful in that, because the client always will need more, and one is in the amount that they need and the amount that they are asking for a loan. So so many things that have been listened now is very carefully to see from the side of the MFI.
And thanks a lot. And I think it's an excellent comment in the sense that I think what has been going on this panel is maybe symptomatic of what's going on in the industry, which is, we're trying to project ourselves, and actually we're procrastinating. And we're building these narratives of, are we social or not? Are we subsidized or not? Are we doing the right thing, or is it wrong and it's probably not going anywhere? Whereas we started by saying we should celebrate the fact that we're huge, we're much bigger than we ever thought we would be, and that the voice, what you just said is also that it works, and so. I don't know, and I feel it, and maybe I can say that since I don't live here. I feel that, in particular, in the United States, there's a tendency to do this microfinance bashing, whereas it's a huge. I mean, we said it's the biggest portion. It's the 2/3 or 3/4 of the GIN surveys find only microfinance as a valid impact investment. So we won't go back in the definitions, but maybe to say, we've said a lot, and if we can spend maybe 3 minutes trying to answer the question of what will we look like in 10 years, and ask some of the equity investors who, either will be happy to enjoy the ride and do a second fund, or might be stuck, or know a lot about the business, but what will it take? What sort of involvement or what sort of investor will it take to continue this journey? Maybe on board a bit of digital, not always. And I'm looking at Momina, for instance, which is holding a lot of equity, I think, in the industry. Or definitely Paul, who's maybe doing a new fund, or Alex or others who are, the owners a bit, not minority owners of this industry.
Very fast. In 10 years, I believe in technology, regulation, competitors, and client needs will be completely different.
I mean, I'm just thinking of our equity portfolio because you said it. The ones that we tend to see, which are, not just doing good but doing well, probably the models who have gone beyond the traditional model. So expanding more into the MSME space, expanding, playing around with digital, really seeing what it'll take to drive costs down for their clients. It's very much dependent on country and regulatory context. So countries like India, which is where, India, China, some of where our larger equity upsides are coming in. And the third aspect, which we haven't really, you mentioned it earlier, which was like team building, but also governance is playing a huge role, I think, particularly on the equity side, because, that really will determine whether these institutions are sustainable in the long term or just collapse because, or bring in a crowd in, larger scale investors, especially when you have them going to IPO, having, smaller scale investors, private investors who are no longer the institutional DFIs or, some of the impact investors.
Maybe I'll just add from kind of one thing we wouldn't want to see is unnecessary government intervention. Nothing beyond just the prudential regulation. And I think several of us have seen what, government intervention can do to really set back the clock in a very negative way. So maybe that's one thing that collectively we can try to do something about.
Just very, very quickly, I would say, obviously there's lots of equity moving into microfinance, huge amounts, and whether it's from banks buying or whether it's, mainstream investors moving in for various reasons. But, so just from my little vantage point, I think that what, managers like us can do is to, as you were saying, which I liked very much the phrase of sort of pushing capital where it wouldn't otherwise go, which I think in the context of microfinance is exactly these kinds of innovations that we're talking about that, and not to revisit the debate of impact, but that could plausibly be considered to have, I'm choosing my words carefully, some kind of social value creation associated with them. So I think there are innovations that, to my mind, wouldn't really fall into that category, that we probably wouldn't be that interested in, but there's quite a few that would be, that I think we've mentioned today. So that's where I think there is a capital need, and whether you want to say that that's where some of the implicit subsidy is coming from, I think is very plausible to say that. But I think that's where there's clearly a need for equity.